So hi everyone. So let's start now with the new topic. We'll be now continuing whatever we have discussed in the last session, and we are now talking about the historical perspective of the monetary policy. So in this direction, I will be also focusing on the recent development. So this is about the monetary policy that we have already discussed. So this is lecture 32. And for this the reference remains same. I have not mentioned about the Deepak Mohanty report that I had mentioned in the last lecture, but rest of the references will remain same. So the economic survey 2018-19, 2019-20 and 2020-21 will remain same here. So here post 1998, when we were in the second phase of the Narasimham committee report. So I think when we were discussing about the banking sector reforms, we had mentioned about this Narasimham committee report in detail. So this Narasimham committee report had mentioned that there is a need to have the liquidity adjustment facility. We should be providing sufficient buffer to the economy and to just make sure that RBI conducts the monetary policy expansion process quite efficiently. So this was also given, and it was also mentioned that the RBI should also be part of the conduction of the option whatever we have the auctions of the government bonds. So there should be some kind of monitoring on that front also, and RBI should conduct the auctions whatever the government bonds that are supposed to be there under the liquidity adjustment facility. In April 1999, RBI introduced an interim liquidity adjustment facility, and it was to minimize the volatility in the money market by ensuring the movement of the short term interest rate within a reasonable range. So it means that whatever we had the overnight rate that we were talking about, so repo and reverse repo rate. So since it was a new recommendation coming from the committee, so it was decided that let's have the some kind of pilot experience. So for that it was created something called interim liquidity adjustment facility in April 1999. And it was also just to make sure that there should not be high aberration in the expansion, the increase in money supply or the decrease in money supply. So either the increase in liquidity in the economy or squeezing the liquidity from the economy. So just to keep in mind. However, the absence of a firm corridor, which means that banks, since it was a new measure, so banks were also not very reluctant or very happy with this particular setup, that they have to just, so RBI always keeps in mind the adjustment in liquidity with the reverse and repo. So since the call money rate had the quite a large volume in terms of trading, so call money rate became one of the important, it started acting like as a policy rate at that point of time under easy liquidity or stress conditions. So CMM, which means that whatever we have the call money rate, it became one of the important benchmarks for the monetary policy. Then in 2011 that I mentioned, there was a committee set up under the Deepak Mohanty committee. It is also called as Deepak Mohanty committee. It mentions about and RBI had created this committee. It was a working group to review the operating procedure of monetary policy, and in this procedure the repo rate was recognized as the only policy rate. So apart from the repo rate, rest of the policy rate that we see on the RBI website that I just mentioned in the last slide, last lecture. So the repo rate will be the reference rate. Based on the repo rate, other rates will be decided. So for example, marginal standing facility, as we saw that the repo rate is right now 4%. The marginal standing facility is 4.25%. Even bank rate is 4.225%, and the reverse repo rate is lower than the repo rate. So the reference repo rate that we have, it started formally accepted and it was formally accepted after the 2011 this Deepak Mohanty committee report, working committee report, and this also gave some kind of legitimacy of the repo rate to be called as the policy rate. So in case of US, as I had mentioned, that it is about the federal funds rate. Now in case of India, after Deepak Mohanty committee, it became like an official declaration of the repo rate, and liquidity adjustment facility hovers around this repo and reverse repo. In 2004, we had one more major development in the area of the monetary policy. It was called Market Stabilization Scheme to manage the since in 2004 we were doing really good. Our economy was having a good economic growth, and at that time we also experienced a huge surge in foreign capital inflows, and that also created extra pressure on the exchange rate, and then we had to keep in mind some kind of volatility experiencing the exchange rate management, and then also there was a there was some kind of cushion required that if there be something wrong with these high inflows of capital, then what will happen and how the overall domestic monetary conditions will be stabilized. So, at that time the market stabilization scheme was launched to manage the very large and continuous capital inflow. So, MSS was initially designed as an additional instrument of liquidity management, and just to keep in mind that since we have the huge inflow of capital happening in coming into the economy, then how we can safeguard our economy with any adverse impact. And under market stabilization, in bonds and treasury bills of the government were issued to the there was at that point of time the government had gone for issuing the market stabilization bonds. So, and the treasury bills of the governments were issued to the market, but these funds were not used for the budgetary conditions. So, government was not using this for the meeting the capital expenditure requirement or the fiscal deficit requirement if there is a higher amount of borrowing required, but this was only for the liquidity adjustment facility and liquidity conditions in case if the central banks wants to utilize. Then we had the era of global financial crisis 2008-9 and 2007-8, and at that time government was in really need of money. There were lot of borrowing requirements coming from the government, and then government took over this MSS scheme, and MSS was used by the government to meet the borrowing needs and to expand the budgetary operations through the I would say desequestration. It is called that when you go for completely suspending the activities and taking over a particular system. So, with that government had gone and it has captured the market stabilization scheme. So, and to carry out the MSS, the government lends its bonds or securities to RBI, and RBI becomes the debtor of the government equal to the value of MSB. So, market stabilization bonds now it is completely in the hand of the government, and similar to what we have the monetized deficit or the deficit financing that we say. So, the market stabilization scheme is now almost has become the proxy of the deficit financing or the monetized deficit, but in the beginning it was just to make sure that we have a sufficient buffer liquidity conditions in the economy to meet any awkward movement in the foreign capital market or even the domestic economy. So, if you are allowing high inflow of capital, then this will also create extra burden on the economy. So, this was the requirement. I have also referred the economic survey 2018-9, and this particular table that you always read in economic survey. So, apart from this, I would also recommend that some of you must go to RBI website, and there you have the monetary policy report. So, in this monetary policy report, I was looking at April and October reports, and then you can see that in the first chapter they give the scenarios of the inflation. This will have the crude oil, exchange rate and all in terms of capital inflow, inflation, everything mentioned with the base scenarios, that on what instance the government or the central bank is going to decide about the rate increase or decrease in terms of repo rate. And they also have the very good table mentioned about that during the period in which all countries what are the stands of the government with or central bank with regard to the monetary policy change. So, the monetary policy committee whatever they have voted, whether they have voted for no change, whether there has been change, so those changes are given. The monetary policy report also gives you a complete idea about the inflationary scenario. So, different components of inflation, the CPI and WPI, plus apart from that we have the household survey about the expectations. So, it is mentioned over there. So, it is always some kind of supplementary, a good supplementary document to read if you are going through the economic survey. So, right now if you ask in detail that if I want to know about the India's economy and everything in documents, so where I should refer. So economic survey is the number one. Plus after this you have two more reports that especially those who are from economics students, they should refer. One is called monetary policy report, and then another is called financial stability report. In financial stability report you will be having the complete idea about that what is the financial health of the country right now, how institutions are functioning, whether are these institutions are going in a right direction. If there is some problem, then government or the central bank will not convey directly, but it will try to signal that there is some stress happening in this particular segment. So those policy makers or those government institutions may would like to go for some kind of revision in their decisions. So normally those who are economics students, those who go and work in consultancy firm, any requirement, you will find that they always monitor or they always go through these reports, and they try to at least draw some opinion on that what is the document, what is the signal that the government is giving, and how we can incorporate in our macroeconomic analysis. So from macroeconomic perspective, the economic survey, monetary policy report plus the financial stability reports are three important documents that one should read whenever you have a time. You don't have to read for each and every chapter, but at least have a look. Yeah, it may develop interest in some sections, and you may would like to pursue for higher studies or for your doctoral research, or if you want to go for any kind of job in the core economics domain. For non-economics also it is important. Now after doing this course, I think you will be having some fair idea about how we can understand the economic survey better, and then you can also explore and read at least first chapter of the monetary policy report, so that you will also have the idea about how central bank decides about the monetary policy. So I will not go by each and every indicator, but the trend, it shows that since everything is going down, so the trend, it shows that the central bank had gone for some kind of monetary policy expansion. So you can see that the SLR requirement from 9.50, which were there on 5th April 2018, it has come down to 19%, which means that banks are now having higher liquidity to go for lending. In the same way, the cash reserve ratio has been kept as a constant 4%. It also shows that the banks do not have to worry about the increase in cash reserve requirement. So the money will be available. So with this table, the only inference that you have to draw is that this table talks about whether the monetary policy has gone for a expansionary phase or it has gone for contractionary phase. If it has gone for expansionary phase, then the rates will be lower, and if it has gone for a contractionary phase, then the rates will be higher. So if the central bank thinks that the price stabilization mechanism is not working properly and there is a need to take action on that and how they can curtail the price, then of course central bank would like to go for raising these indicators up, and once they raise up, there will be liquidity squeezing happening, and this will create some kind of extra pressure on reducing the inflationary scenario in the country. So because money will be available in the limited amount to everyone, and then as a result the money supply cut will again have the positive impact in reducing the inflation. But in some cases, when we have the special situations, like for example we had gone for demonetization, where we had suspended the higher denomination of notes, at that point of time this policy table will not be sufficient to understand, because those are structural breaks that we call as an economist in normal economics context, that if a sudden shock in the economy and that leads to a huge amount of change in different segments, that are called the structural breaks that we have. So since the summary is that since 2018-19 there is a downward. So from 5th April, so here we have the 5th April, so it is 6.25. Then by October we had the increase in interest rate, then again it has gone down. So 0.50 was the basis point was the increase in the bank rate. Here in the repo rate you can see that we had the 6.50, 6.50 and 6.50. So which means that during this period there was some kind of apprehension that price will increase or there will be some kind of inflationary pressure. So as a result, this particular period had seen increase in the repo rate, but after that there is a decline. With that also can be linked with the 2019 development that we had seen. But rest of the indicators are same. Reverse repo will always be lower than the repo rate. So those rates are being reflected here. So overall, this is the trend scenario that we can say. Recently, on Ministry of Finance website, you will find that there also they have now come up with the economic survey 2020-2021. So I was going through the chapter 3 of this, and then we find that post COVID-19, when we had the outbreak of a pandemic, we had the coronavirus pandemic outbreak. Since then, February 2020, and so the central bank had taken measures, and it had revised the repo rate to 5.5%. On 27th March, it revised again to 4.4%. On 28th March, again it kept the same. On 17th April, it kept the same. On 27th May, it revised again to 4%. That clearly shows that since at that time the economy was facing the unprecedented lockdown, and then it was also a time where the economy was needing some kind of excess liquidity to support or to meet the requirements of the pandemic related the regulations and the need at that time. So you can see that it is all in lower order. So these numbers clearly shows that the central bank had gone for creating extra liquidity in the economy during this period. So this table also shows about the same, right? And this is what it says. So repo rate, then we have the reverse repo rate, then we have the cash reserve ratio and the statutory liquidity ratio that we have, and the bank rate and the marginal standing facility rate. So bank rate and marginal standing facility rate, we have the same, not much change, but there are some other incentives given. For example, marginal standing facility has now, I read somewhere that it was extended to the regional rural banks also, cooperative banks also. So those excess benefits we will discuss maybe when we will be going for closing of this course. So maybe towards the end I will be mentioning only the recent initiatives during COVID-19 and how we had to implement we had to take certain measures to tackle this unprecedented shock in the economy. But from this table, it is clear that the central bank has gone for a revision of the policy rate, which is the repo rate, and it has come down. So repo rate from 5.5%, it has come down to 4%. So 1.15 basis point it has. So 115 or so it can be called as the basis point for the cut. So because of the pandemic, we had to go for such changes. Here we have the monetary aggregates. So one of the reasons why I had to discuss this in the beginning itself, when we are discussing about the types of money and the different types of the reserve and the broad money and high powered money. So at that time we are now we are mentioning about what is called growth. So here YOY means that year on year growth, which means that compared to last year. So in case of economics, we have some indicators which experience the seasonal variations, and seasonal variations should be accounted. So for that, we have in economics, we talk about the seasonality and non-seasonality testing. So once we have seasonality testing, it means that if we have to make sure that there is no seasonality effect on the macro variables. For instance, the inflation is a seasonal phenomena. If you go for higher frequency analysis, a monthly analysis of inflation, then you find that when we have the festive season happening around September, October, November, at that time we see that inflation is having a higher likelihood that it will go up, because at that time, because of the higher expenditure of the across class, this leads to a higher demand of certain products, and this higher demand of certain product if it is having aberrations, then this will lead to some kind of variations in this will lead to some kind of variations in the whatever price scenarios that we experience. Now to deal with, you will find that most of the economic indicators are adjusted. So year on year means that this year minus last year upon last year, not just previous. For example, if I am calculating for January, so it will be January 2021 minus January 2020 upon January 2020, not just January 2021 upon December 2020 and then December 2020. That's not the case, because with this we cover the 1 year duration, and with that to some extent it is seasonality effect is also taken care. But if you are working on yearly data, then you don't need to work on. If you are working on quarterly data, if you have quarterly data to analyze, then you may be considering, but monthly and higher frequency it is required that you should be taking into consideration the seasonality effect. So here we have the growth y on y in monetary aggregates. So here we have the first variable is it talks about the circulation, currency in circulation. So you can say that in 2016-17, because of the shock that we had experienced in terms of demonetization, it has gone down by -19. Then 2017-18 we had the remonetization phase. So we had demonetization in 2016 towards the end, and then in 2017-18 we had the remonetization phase. Then again it came back and it was double. So this was one of the reasons at that time it was mentioned that though demonetization scheme has led to the encouragement of digital payment system, we had gone for some kind of RuPay, and there are different types of Paytms and all were launched, but still circulation of rupees notes or in terms of currency, it was almost doubled. So 19.7 minus 19.7 was the liquidity squeeze because of this higher denomination notes. But after that 2017-18 it had just double. So which means that from the pre era of the cash circulation we had, it has just gone by 37%. That had also created a lot of buzz among the economists, and at that time it was mentioned that the demonetization scheme is a big failure because it has not been able to reduce the cash circulation, rather it has doubled the cash circulation. So that was also one of the reasons. So here it is reflected. But by 2018-9 we had it got adjusted, because then we had to go for the introduction of the lower denomination of notes. So at that time we were just relying more on the 2000 rupees and 500 rupees, but then the introduction of lower denomination notes, so that was also led to a decline in the circulation of currency in 2018-9, and then after that it has been quite stable. In 2020-21 it has gone up a bit because of the certain developments that we had in the beginning of 2020, and the most of the banks outlook were also better in 2020 because we had gone for certain measures, and because of that the confidence was revived. Cash with banks, it was -2.1 2017-18, 2016-17 it was 4.2, but by 2018-19 it was surplus 21.4. That also shows that banks were filled with cash, and that's why at that time you must be you can remember that at that time those who are in job, they were getting a lot of calls of the personal loans and all, because banks were filled with cash with the whatever we had. So here it was also the third indicator, we have the currency with the public. This also shows that -20.8 was a decline, and this has also almost doubled. So this has also resulted in a higher increase in the demand for currency from the public, and this has gone from 16.6 to 14.5. Then we have the bankers deposit with RBI. This is almost more like stable, except that 9.6, that was also quite possible because we had gone for the squeeze, which means that the banking sector outlook was really not very good, and at that time government have also given some kind of leeway so that this particular amount can be used for other. For rest of the things, narrow money and all, we see not much change, except that in reserve money, narrow money, the effect of demonetization is seen, and after that we have this. Otherwise we in 2020-21 it has gone up, because then we had the periods of analyzing the higher expenditure, right. And in terms of broad money, I see a lot of stability, not much change. So the money supply is not having that much impact here, but the demonetization is clearly seen in this case. Then here we have the M0 CRR adjusted, and we have the currency in circulation. So that also you can see that it has the whole lot of adjustment. So especially after March, when we had lockdown, we can see that the M0 was the highest, which means the cash currency, and it was highest. It got declined somewhat in October, but after this, so most of these things are going up, because at that time everyone wanted to go for. So, CRR is in the middle, you can say circulation is also low, but M0 whatever we have the cash currency, it has gone up. So, expenditure was high during this period, lockdown and post lockdown period. People had gone for buying some sanitizers and something for their well being, and that is why it shows that there is a higher expenditure. Money multiplier also, after adjusting for reverse repo, it looks like that it has gone down, but money multiplier, it is more or less stable, not much change except April 2020 when there was some aberrations, but after that it is more or less stable, not much to be discussed. So, overall what it looks like that in 2020 2021, these charts whatever we have analyzed, it gives you a clear idea about that what is going on the economy, what is the money supply conditions. So, in the beginning chapters are mostly linked to the liquidity management in the economy, how liquidity is managed. So, if you read these chapters, especially those who are from economics and non-economics background, at least now you will be able to analyze and read those chapters with confidence, and you will have some idea about how we can understand these particular tables better, because economic survey, especially this particular chapter, becomes really tough, unlike the social sectors and all, where it is quite easy to understand that this much amount was invested and this much amount is targeted. But in this you need some understanding about how this broad money and the narrow money functions are taking care. I will be continuing in the next class. In the next session again we will be having something on the recent measures we have undertaken, and some measures are mentioned in the economic survey. So, I thought it is worth mentioning here, because these are unprecedented times. So, there are some rare tools are being used, and those tools are being also extended to some other activities. So, that is why I thought it is better that we should be mentioning about this, and I will end this lecture here. Thank you so much.